Welcome back to The Explainer. Today, we are diving headfirst into a clause that, let's be honest, can be a real minefield in a tax audit. It's a place where tiny mistakes can create some pretty big headaches. Clause 18 of Form 3CD.
So let me ask you this right off the bat. Are you absolutely positive you're claiming depreciation the right way? Because a slip-up in this clause isn't just a simple typo. It can send ripples through your entire tax computation and, attract the kind of attention nobody really wants.
So here's our game plan. Over the next few minutes, we're going to go from confused to confident. We'll start with why this clause is so darn important, then we'll break down the depreciation table itself. After that, we'll get into the nitty-gritty of adjustments, see how special tax regimes change the rules, connect the dots to other clauses, and we'll wrap it all up with a super practical checklist of what to do and what to avoid.
Okay, let's kick things off with Section 1. Why is Clause 18 so critical? Well, think of it as the bedrock, the very foundation of your audit.
The guidance note from the ICAI really hits the nail on the head. A tax audit isn't just about ticking boxes. It requires sound professional judgment. And Clause 18 is the perfect example. See, it doesn't ask for the depreciation you've booked in your accounts. It asks for what's allowable. And that one word, allowable, changes everything. It means you, the auditor, have to apply your knowledge of tax law to the specific facts of the case to figure out what's truly deductible.
All right, on to our second section. Let's get our hands dirty and deconstruct the core task here, the depreciation table. We're getting into the real nuts and bolts now. Okay, so this is it. This is the grid we need to conquer. It's pulled straight from Form 3CD, and this is our framework. The mission, should you choose to accept it, is to fill out every single one of these columns perfectly.
Everything, and I mean everything, starts right here in Column 1. Classifying the asset correctly. Is it plant and machinery? Furniture? This isn't just about getting the name right. The block you put an asset in decides its depreciation rate. If you get this wrong from the start, the entire calculation that follows is going to be off. It's so important that the guidance note even says for tricky assets, it's okay to rely on an expert's opinion.
Next up, Column 3. This is your starting line. It's the written down value, or WDV, that you carried forward from last year. But here's where it gets interesting. That term, actual cost, especially for new assets, it's not always the price on the invoice. It's a bit of a chameleon, and we're about to break down exactly what goes into it.
Now let's focus on a major pitfall in Column 4. You have to report the date an asset was bought, sure, but the date that really matters is the date it was put to use. That's the trigger. If an asset is put to use for less than 180 days in a year, you only get to claim half the depreciation. This is such a common error, so it's best practice to get a signed representation from management locking in these dates.
So, if we boil it all down, the basic workflow is these 4 steps. First, classify your asset into the right block. Second, lock in that opening written down value. Third, be super careful with your additions and those critical put-to-use dates. And finally, apply the correct depreciation rate. It sounds straightforward, but as you know, the real complexity is in the details.
And that brings us perfectly to Section 3. This is where things get really interesting. Mastering the adjustments. This is where we figure out what that actual cost really is for tax purposes, and it's not always the invoice price.
The Income Tax Act is very specific here. Your actual cost has to be adjusted. You need to reduce the cost by any GST input tax credit you've claimed, any government subsidies you received for that asset, and any part of the cost that was paid for by somebody else. And if you've imported the asset, you also have to adjust for foreign currency fluctuations.
Let's take a look at a super common mistake with GST. It's so tempting to just use the total invoice value. But that's wrong. If you include the GST amount, you are inflating the asset's cost and claiming way more depreciation than you should. The correct way, as you can see, is to calculate the cost net of any GST credit you've already taken. That way, you're only depreciating the true cost of the business.
And the financial hit from these adjustments can be huge. Just look at this. A government grant knocks 10 lakh rupees off an asset's cost. With a 10% depreciation rate, that one little adjustment means you're claiming 1 lakh rupees less in depreciation over time. These aren't just tiny details. They have a real impact on the tax bill.
Okay, let's move on to Section 4, the impact of special regimes. This is getting more and more complex, and if you miss this, it can lead to some major compliance issues.
So this is a huge warning sign. If the person or company you're auditing has opted into one of these special concessional tax regimes, you have to throw the old rulebook out. The standard depreciation rules you're used to might not apply at all.
As an auditor, it's your job to check. Is your client under Section 115 BAC, BAA, BAD, or BAB? Each of these has its own specific set of rules about what you can and cannot deduct, and that often includes things like additional depreciation or using brought forward losses. This has to be step one in your process.
And this quote from the law just shows how serious the impact is. If someone is under the new default regime, 115 BAC, any old losses or depreciation they were carrying forward, well, they're just gone. Poof. They are considered fully used up and you can't claim them again. It's a total reset from the old system and can dramatically change the tax math.
Now for Section 5, interlinking with other clauses. You have to remember, Clause 18 doesn't exist in a vacuum. To get your report right, you've got to connect the dots with other parts of the form. Here are 3 huge connections you need to make. First, always check Clause 8A to see if one of those special tax regimes applies. We just saw how critical that is. Second, cross-check with Clause 19. If an asset got 100% deduction for something like scientific research, you have to make sure it's not also in your Clause 18 schedule. That's double dipping, a big no-no. And finally, don't mix up Clause 18 and Clause 32. Clause 18 is about the depreciation that's allowable this year. Clause 32 is about the unabsorbed depreciation you have to carry forward. They're 2 different numbers.
All right, let's bring it all home with our final section, pitfalls and best practices. Think of this as your go-to checklist to make sure your Clause 18 reporting is absolutely rock solid.
Let's just look at this side by side. The common mistakes: classifying assets wrong, not getting proof for the put-to-use date, messing up the cost by including GST, and totally forgetting about special tax regimes. The best practices are the direct solutions. Use an expert if you need to. Get those key dates in a signed letter from management. Always calculate costs net of subsidies and ITC, and make checking Clause 8A your absolute first step. This right here is your formula for getting it right.
So I'll leave you with this one last thought. Once the report is filed, it's easy to just move on. But the real question is, are your working papers for Clause 18 truly bulletproof? Can they stand up to scrutiny? I hope this explainer gives you the tools and the confidence to make sure that answer is always yes. Thanks for watching the explainer.